Nifty had the worst losing streak in the last 28 years. It's been falling since September 2024 till today, which is March 2025. And this is the biggest losing streak we've seen since 28 years. Now, as of March, investors' wealth has eroded by 95 lakh crores. That's how much wealth all Indian investors have lost in total. What's interesting is that the market capitalization of BSE listed companies, basically all the Sensex companies, fell by nearly rupees 100 lakh crore. So that's obviously a very big deal. Since October 2024, the Nifty 50 and Sensex have dropped by over 14%, making them the worst performing indices on the global scale. Now, the real question is, why is this happening? So we have taken the top reasons and we're going to look into that right now. The top reasons are basically that foreign investors are leaving India, then you have weak corporate earnings and generally the economy is slowing down. You have small cap and mid cap stocks which are in a bear market right now, and global factors and trade tensions thanks to Mr. Donald Trump. And finally, you have the general panic that mutual investors have. Now, we're going to go into detail into all of these topics, so stay tuned. Remember, at the end of the video, we will also tell you how to react to this market crash. So you, as a retail investor, know how exactly to navigate this without losing more of your wealth. So number one, foreign investors are leaving. So foreign institutional investors have been exiting the Indian markets at an alarming rate. They've pulled nearly $25 billion, which is the biggest foreign investor outflow in history. So why are foreign institutional investors, FIIs, whatever you want to call them, why are they not happy with India anymore? Well, the answer is pretty simple. The money is flowing into China, and also the money is flowing into US government bonds, which is giving them safer returns. So you should see, so there was a pattern before this where foreign investors were taking out money from China and putting it into India. And now you're seeing the reversal happening. You see a lot of money going back into China. A lot of this can be highlighted to recent developments that have been happening in China, but that's probably better for another video. Number two, weak corporate earnings and economic slowdown. So basically, the earning growth of Nifty 50 companies has dropped to 5% for the October to December 2024 quarter. What's sad about this is basically that this is the third consecutive quarter of single-digit growth. Now, in 2022 and 23, we had seen a double-digit earnings, and for that reason, this is a sharp decline in earnings for companies listed on the Nifty 50. Now, what exactly is affecting this is that urban consumption has slowed down. Salaries have been stagnant, so a lot of people are not spending as much as they used to anymore. Another thing contributing to this is that healthcare costs are up by 14%. You have education costs are up by 15%. So you can understand why people are not spending as much as before. Another thing to note is that the expected GDP growth was 6.4%, but the actual recorded growth was 6.2%. What is very interesting about this is that costs are rising, but the companies are still not earning. So that's a little bit confusing. So in this chaos, the financial sector also is expected to be hit by this. So reports are suggesting that private banks may post weaker than expected earnings in the upcoming quarter. Number three, small cap and mid cap stocks are in a bear market. So in 2024, mid cap and small cap stock owners were going crazy, celebrating, popping champagne and all of that. But since then, mid cap and small cap stocks have lost 26% of their value. So in February alone, they fell by 13%. So that confirms that the stocks are in a bear market. So historically, what tends to happen is that mid-cap and small-cap stocks, during a market downturn, they do really bad. But when the market recovers, they do really well. Number four, global factors and trade tensions. The rupee is extremely weak, especially because of the trade war that has taken over the entire planet, thanks to Mr. Donald Trump. Now, another global factor that has been contributing to our decline is the US bond market is drawing a lot of capital away from India. So the Feds have kept the interest rates pretty high, and for that reason, foreign investors are preferring, as mentioned, US bonds more than Indian investments. So even though India is considered an emerging market, you have a lot of investors moving towards US bonds right now. So what should investors do? So if that is you, we recommend staying invested in the markets because the markets will eventually rebound, and pulling out your money right now could miss out on those gains. However, if you are in need of liquidity right now, it makes sense to pull out from volatile stocks. What tends to do better right now are large cap stocks in defensive sectors. And defensive sectors mean something like consumer goods, FMCG, pharmaceuticals. These stocks in these sectors tend to offer more stability. For those SIP investors out there, this is a great time to accumulate units at lower prices. Obviously, as an SIP investor, you are aware of rupee cost averaging, and you can take a big advantage of rupee cost averaging at these times. However, none of us can guarantee when the markets will recover. If the markets will recover, not joking, markets have to recover, because if they don't, it's a very, very dark time ahead then. SIP investors, right now, best thing is to continue investing. If you want to take the risk, of course, you can increase your investments and kind of boost your gains when the markets recover. But that's all we have for this video to explain why the markets are crashing right now. If you like this video, please like, subscribe, comment down what you want us to talk about next, and stay tuned for more. See you guys.